Well, we're finally at that point that most people want to start the process, and that's talking about money. I have, over the years, repeatedly run into people that have come to me, or we're involved, or we meet them, or they're referred, and they say, I understand you can help me raise money, or I need some money. I've got a great idea. They want to start with raising money. Um, that's just not the way to do it. So again, everything I tell you, there are always exceptions, and there's that unicorn who walked in and told somebody, I've got an idea, give me some money. They got it, and they went off, and they were successful, and everybody lived happily ever after. But that's more in the genre of the stories I used to tell my daughter and read out of her little books. So we're going to talk about the dollars in two different parts, as I indicated in my earlier emails. And there's finance and there's accounting. We're going to deal with accounting first. Accounting is a financial function. Finance does not always involve accounting. At some level it does, but they're separate but very related. But for you as a small business person, accounting is where you really keep track of what's going on. Now, as we've stated repeatedly, and I'm really loving this lean startup form of getting forward, because your feedback's been very valuable to me, and we have people going through this course. Some have been in the mastermind, some of them just we've been talking to that are really looking at a range from going public or being acquired down to small, home-based, and don't want any employees, don't want a physical location. So getting this message across in a way that makes sense to all of you is a challenge, and it's helped us refine a better way to do that. But at the same time, I would remind you that the principles we're talking about apply to everybody. Now, how those principles are implemented and how it affects your particular business model differ, but finance is really, as we'll talk about today, this first step in coming to understand your involvement as a free enterprise warrior. Now, I have had a couple of meetings. I shared a couple of those with you in my last video with a couple of key people in this industry, and one of them has trained thousands of, in fact, potentially tens of thousands of entrepreneurs. And we both, it's really been driven home to me, and I just want to share with you that there are many, I've known this, we've written about it, but I'm really wanting to re-emphasize this in the materials we go forward, because it pertains to one or two of you from my conversations. And I want the ones that doesn't pertain to understand the contrast. The Millionaire Next Door is about a lot of people, millions over the years in the United States, who have created their own job. They run a small business, and they make a good living. Now, within that, many of them make a lot of mistakes, particularly in the area of their exit strategy and their exposure to risk, and those are different discussions. But the issue is, a free enterprise warrior is someone who is choosing to enter the marketplace to build a business that's more than a job. In other words, they're wanting to hire other people, or they're wanting to have products. They may remain as an Elm Street player without employees, but they'll have a lot of freelancers and or other people helping them in their operation. And they want to grow more than just making a job. It's fine if creating your own job is better. In fact, the statistics show individuals who run their own job, run their own business, generally, if they're successful, make more money than if they worked the same hours with somebody else. Another discussion, but I just want to make it clear here that most of the material we're sharing pertains to the side of getting out and growing and being a major player in your niche. However, the accounting side applies to everybody, whether it's the job or whether you're wanting to get in the trillion-dollar journey to take your company public. But it comes back to why this course and why this particular lesson is, again, to help you develop the mindset. What are you trying to do? And to keep that as the measure, because you're going to be overwhelmed with everything that we're talking about, everything you read and you see, and just the flood of information about running a business and starting a business and what you should do and what you shouldn't do. But then giving you that framework that's appropriate to your particular form of business, and then the content, and that's, of course, the strategy is seven. The 7 areas of business to apply to every aspect of business, regardless of your scale. So we've been going through these points. As you know, so far, we've talked about the strategic, and I won't dwell on that, the corporate, the marketing, the product. And over the last class, we combined after product with operations and administration. Had a pretty good mastermind from that, and a couple things we're going to follow up with. But as again, today, we're talking about the accounting side of the finance part of the strategy of 7. 3 simple questions. What is your burn rate? Now, if you're a successful, established business, burn rates normally applied to it's a venture capital term. How much cash are you consuming every month? If you're in a successful business, you could well be generating plus cash every month, or most months, depending on whether you're seasonal. The implication here is that if you're in a true startup, that you're burning cash, that you have to have a certain amount of cash that as you're going through it. Others like to call it the runway. How much runway do you have? That's how much cash you've got in the bank and how fast you're eating that cash as you go down that runway before you get in the air. And we'll come back and talk about that. Very critical if you're in that situation to monitor it and to know how you monitor it. In most cases, a daily basis. In some cases, even a couple times a day. And what's it going to take to get that airplane off the runway or get to where you have at break even your profitable cash flow? And then what is your capital structure? Now, we're going to talk about that really next week when we transition into finance. But your capital structure in the startup and the accounting phase is going to define how much of what you're doing every month to get where you're going is burning up your cash or driving you into debt or using up the equity that you use to get that cash, whether it's yours or outsiders. So again, just to really make that point between the difference between finance and accounting, a lot of people like to talk about finance as more about the future. It's models, it's projections, it's where you think you're going to go. If I sell 10 million of these things, I'm going to be a millionaire or whatever. Accounting is more of a historical. This is what's happened. It's a record of what transactions you were involved with for your company, where your cash went, where your revenue came from, and it's a reporting process. So you can mentally be thinking about these core differences, that finance is more the future, accounting is more the past. Accounting is more about what's happened and where your money went, and capital is more in the finance side. How do I accumulate and how do I get hold of the capital I need? And remember, capital is not just cash to run my business. Accounting is more about numbers, and finance is more about your overall working capital. That's a term we'll talk about some more. And then accounting is more day-to-day versus your longer term. So if you begin to separate that out, the bottom line, however, is that as much as I don't like it, I'm not an accountant, never have been, have had to spend way more time, but over the years have read literally thousands of business proposals and annual reports and prospectuses. And every one of those, there's 3 parts about it. There's information about the industry this company is in. There's information about the management. It's actually called the management discussion analysis. And then there's numbers. There's a lot of other, but those 3 things, if you have those, you can pretty much know what's going on with the business. And ultimately, it comes down to the numbers. All the glowy words and the marketing materials and the glossy substance. One of the things, many of you are too young to remember it, but it was a generational defining moment, was the dot-com bust, where there was a brief period of time in the late 90s when the whole digital marketplace was taking off. Everybody said you don't need to worry about the numbers. The market's so big, it's so great, we'll worry about profit later. Didn't work that way. That's why they call it the dot-com bust. So really what you're going to be dealing with, and I take this chance to explain how we came up with the JCI logo, there's 3 phases of accounting and financing for your business, both accounting and financing. First is your pre-launch, and as you can see here, This is that phase where you really haven't gotten into the marketplace, but you're buying reports, you're paying consultants, you're paying lawyers, you're spending your own time and money figuring out what is my business going to be. And then there's a point zero where you launch the business, and in almost all cases, you continue to drain your cash. You continue to draw down on the capital you have till you reach a certain point at which you begin generating more cash, some amount of cash, not more than you're spending, but you're not spending at rate. Your burn rate's not as great. Again, that term burn rate. But you reach a point where finally you're out developing the business and generating profits and hopefully cash. Now, there's three distinct pieces of that process. In the early planning, pre-launch, that's where you almost always are using seed capital. There are exceptions. We just can't talk about the exceptions in this. So when I'm speaking the generalities, I again apologize, but to be focused here, you're going to be using your credit cards, your bank account, you, maybe a couple of people with you, and a whole set of traps there, but you're spending money to figure out if this is what I want to do. In some cases, you may even be building a prototype or paying a lawyer to search patents. Then you're actually into the planning, pre-launch, seed capital, and friends that get you into the planning. There's planning in all three of these phases, but here you're actually getting into the marketplace. You may start spending money before you're selling anything or you're actually in the public, whether you're a restaurant or a software product. But you're serious. You've made the decision. You've crossed the Rubicon, so to speak. Then there's that point where you're actually developing and expanding, and you would do a little bit more seed funding maybe. And at that point, you're probably doing enough. You have to pull in some of your friends, maybe one or two angel investors, friends of friends. But then you're getting to where you may need enough money. You've proven the concept. You need what's called an A round of funding. And we'll talk about that next week. So that's why we have this logo. It's all about what happens in that red zone and how you get out of that and whether you survive to get to that point where you're in a situation you return it. Now, as I said in the earlier videos, remember this, of course, and being a marketing guy, and this is the endless, I wouldn't call them barroom, but there's endless discussions between people in the startup business about what's more important. And the whole concept comes back, nothing happens until someone sells something. Now, that's attributed to everybody from Watson to Ford to, it doesn't matter who said it, it's the truth. However, and I begrudgingly admit this, the important thing is you may have made a sale, and as a salesperson, and even as a non-salesperson that's just getting out, it feels great to make that sale. But why they call it business and not sales is that you have to make what was sold. You have to create it, or you have to put it together, or you have to ship it from somebody that has made it. You have to deliver what was sold, whether in person or as a shipment, or, again, depending on your business model. And here's where we get into accounting. We've already spent money in those first parts. We got to know what was there, but now we've got to collect the payment on what was sold. One of the reasons, as we talked about last week, makes this the best time in the world to be starting a small business is it just boggles my mind. And sometimes when I do something and I've done it for somebody and they click PayPal and I get a little email, I barely send the stuff off to them, and then boom, I've got money sitting in PayPal. It's just, every time that happens almost, I just go, wow. That's so different from before, when you had to turn over the bill, write up an invoice, have somebody type it up, then mail it out, then hound them for it, or be told the check's in the mail, and then you had to get the check and then put it in. And as you learn it, back in the day, the check had to clear. And then all of that has to happen, and then you've got to make sure, and this is where accounting comes in, that you've made a profit on what was sold. Now, I just can't emphasize this concept of profit enough, and nothing is more, shows how perverted some of the views of business are in our society today, that people are embarrassed about the idea of profit or wanting to make profit, or how successful certain idiots have been in making us feel guilty for making a profit. And I say idiots on purpose because of another whole discussion we have. That's not meant to be demeaning or emotional. It's just, it shows a tremendous lack of ignorance. If you enjoy anything about our world today, excuse me, to have a problem with profit. So now, here again, we start seeing how the Strategy 7 is integrated. What we talk about in a couple of different classes about our product service matrix and our cost of goods sold. Excuse me, had to get back at me. That all comes down to the concept of pricing, your pricing strategy, which we won't review here. But all of that has to be done in the context of your profit goal. In other words, you have all these expenses that we're going to talk about a little bit. You have all these costs. You have all this investment. Then you got to generate a sale. You got to get that sale delivered and collected. And in the final analysis, you have to determine if you've hit your profit goal. Not just made a profit, but made a profit that fits your goal. Now, I have sent you some other materials, and we're not going to get into this today. We'll spend a couple of hours on this in the more advanced classes. But it's important for you to understand the concept of a break-even analysis. And it's really very straightforward. And even using this chart, I hesitate to do it because some people are intimidated by charts. But you got to suck it up and deal with a little bit of this if you're a free economic warrior. First of all, realize that when we say cost of goods sold and we say variable cost, this dotted line here, you have a business, you have fixed costs, okay? Now, whether you have bricks and mortar or you're paying insurance or you're whatever it is you're doing, you have costs that occur every month that you've got to pay, whether it's employees or your insurance. Those are just fixed costs. But if you don't sell anything, that's what you know your expenses are. But if you start selling things, then each sale, whether it's shipping or cost of goods sold, has a variable component. These two stack together. I'm sorry, this is your fixed cost. These two stack together give you your total cost. And then you have to have revenue. And there's a break-even point where your revenue exceeds those costs. And that area in this area indicates profits. Now, it doesn't indicate cash flow. We'll come to that in a moment. But this is the holy grail of every business, is to be in a situation where you're generating revenue that is above your break-even point. It introduces a whole different set of issues, but if you don't get there, you're not going to exist very long. Remember what we say, there's no amount of cash, no amount of capital that can guarantee success if you're not making a profit at some defined point, and that point always has to be sooner rather than later. Now, within our little group, we have what we call the Dirty Dozen Dictums. And I get into that later. You'll have a download of this that you can look at, and we'll explain the others. But this deals with the accounting and the money side of it, and we have a whole different discussion on fools. There are bad fools and there are good fools. The free enterprise system depends on having a lot of good fools, and what we're trying to do is eliminate a lot of the bad fools or the ignorant fools. There's a lot of wise fools that are purposely taking a chance. You know, Henry Ford was one of those fools. Elon Musk is one of those fools. The people that invested in Apple, they were those kind of fools. But that doesn't deal with the people that just blithely go into starting a business or investing in business, don't know what they're doing. But there's 3 rules. We've tried to, there could be 14, there could have been 10, but we've settled on 12 basic axioms that we share that are universal principles. The first is that cash dictates destiny. You simply cannot survive in business without cash. Cash today is not just the paperwork you have, but it's the account in your Venmo or your PayPal or your bank that you can send transfers from. You can't make payroll with your inventory or an invoice, accounts receivable. You can sit there saying, look, I've got this, but I can't give you, try to give that inventory to your employee if you have employees. Now, I've got a story. I don't have time to tell it today, but maybe on the mastermind, remind me, I'll tell you my bookstore, when we bought some bookstores, and how I had to teach one of my better employees about the difference in cash and inventory. Likewise, profit does not equal cash. This is probably one of the most difficult things that I have found that non-experienced business people have to grasp. They just can't get their head around the fact that, and it's repeated over and over again, that well, I don't have enough money, I just got to go sell some more. In fact, that can be the very thing that destroys your company. If you're short of cash, you need to go out and sell some more. And we can talk about that a little bit when we get into the statements, but that's a whole discussion by itself. But the other side of that is you can be in a business that's generating a lot of cash, and that's going to hide the fact that you're not making a profit. If you spend a lot of your money up front, or you have a lot of credit, or you had the ability to generate a lot of cash, and you haven't taken into account all the expenses, the cash can confuse you and make you think you're doing well when you're on the verge of collapsing. So it all comes back to, again, the mantra we repeat over and over and over again. Profit is essential. It's stupid to say you have to have oxygen to live, you have to have blood to live, you have to have food to live, you have to have water to live, but that's axiomatic. And the fact in business is that profit is essential. You can't justify anything you're doing, taking investors' money, working as hard as you are, taking the risk you are, consuming society's resources, if you're not going to make a profit. So if that's the case, if that's the universal criterion, that means that business is numbers. And the nice thing is you don't have to be an accountant to understand that. In fact, you shouldn't be an accountant. Many of you may be accountants in your background, but your accounting strength's only going to get you so far in business, but it's going to be a tremendous help if you do know how to sort out your numbers. Now, there's all these terms, and they literally are overwhelming, and I have another story that I don't have time to tell you about when I first started learning about accounting, but I was actually in a large corporation and given the responsibility of running a small division that was working with small businesses and developing new computer programs, and I did not know what accounting was at that time, and that's a terrible thing. But most people in corporations do not understand accounting, believe it or not. Many of your most successful businessmen don't know the first thing about general ledgers and in double entry and count. They know what affects their budget and their number, but they don't understand how all those numbers relate together. So the first thing you have to do is get a knowledge of the terms you're going to run into. Now, that knowledge does not give you wisdom. It does not give you the ability to make the decision, but it starts the process for you to use the advice of the professionals you work with, your CPA, your bookkeeper, your banker, or whoever you're listening to, and it helps you communicate your needs for what you're dealing with. Otherwise, you're just simply saying, I'm out of money, and that in and of itself limits the number of people who will work with you, because it shows your naivete. Or if you simply say, I want some investors to give me money to go do this, and you can't answer their basic questions about your break-even and your burn rate and your profit and loss projections and your cost of goods sold and your average accounts receivable timing. If you don't even know what those mean, that tells them you don't understand business. You may know more about your particular idea and your particular product. You may be extremely gifted, and people pat you on the back. You know a lot about this, but if you're trying to turn that into business and you don't know these things, then you're out of luck. And that goes into things like, understanding the difference in your financials and your financing, and understanding what a profit and loss, cash flow, balance sheet, the relationship of these issues. And these are just, I pared this down for this presentation. There's about 28 basic terms: accounts receivable, payable. I will tell one story. Early on, after I'd gotten a little bit of experience, and we had our educational software company, we were out buying little educational companies. First time I was doing that on my own. And there was a professor that had developed a pretty nifty little program for elementary schools, one of the first Apple programs. So he wanted to do more with it, and so we decided we were going to acquire his company, went through all that process, and early on in the due diligence, he had told us he had a very large accounts receivable, and that affected the price and he was only asking a certain price for his company, and the two didn't fit. He was asking for a price for the company well below his accounts receivable, so I assumed he had a lot of accounts payable, so that whatever from the accounting equation, what it turned out is here was a professor who had developed a good program, who was out in the marketplace, had sold nearly $1 million worth of his product, but he called accounts receivable his record of every program he had sold. In other words, that was his gross revenue inception to date. So it just highlighted how very, very bright people, and he had to do something because he had he was a professor at a university, and the business was demanding more time, and he was hiring people. He was on the verge of losing the business because he hadn't dealt with it, but he didn't even know the basics in his business. So that's essential. Now, most of you will need an accounting professional to help you. If you're truly an Elm Street, out of your bedroom, in your skivvies type entrepreneur, you can use QuickBooks, Peachtree, half a dozen other programs today, and they're coming out with new ones every few months. And that's a whole different discussion. So you can do your accounting, your bookkeeping yourself. You can keep track of your sales, and many of the online groups now give you basic accounting and information, very much different than it was even 20 years ago. But if you're serious about growing, if you're that free enterprise warrior that's going to be out there and expanding, you're going to need either a bookkeeper and or an accountant and or a CPA. And you need to know which one to choose, which one to use, who to choose, and how to choose. We can't get into that today. We have other materials on that, and if any one of you in this beta, part of the benefit of going through this beta, if you're grappling with that yourself, send me an email. We'll schedule a time to talk. We'll go through that. But be aware that a bookkeeper is not an accountant, and I include a infographics in your email to start defining where your bookkeeper basically enters the numbers and keeps track of things. Your accountant tells you where to put them. And one of the first questions your accountant's going to help you decide, and it can be your bookkeeper, is whether you're going to run your business as cash or accrual. Very important early decision. Again, no effort right here to totally tell you what that is, other than write this down. Am I going to run as a cash or an accrual business? I'm going to believe that the majority of you at this point are probably going to run as a cash business. But let me show you the primary difference. In this chart right here, you'll notice the same company, the same activity. They made an $80,000 sale that cost them $50,000. But if on a cash basis, it shows they made a lot of money in year 2 and lost money in year 1. On the accrual basis, they made money in year 1 and nothing in year 2. And it doesn't make sense unless you take time to really understand what's going on here. But it makes all the difference in the world to your banker and to your investors and other people, whether you're running as cash or accrual. And depending on the type of your business, it's really a basic of an issue of timing. Simply put, if you, in a cash business, it's all about if you got the money that you sold for the products or services you sold, and you spent the money that you owed in a given year on a cash basis, that's all recorded. However, in an accrual basis, you keep a track of what you've sold and what you've received, and in this case, say they owe you money that they're going to pay you next year, you don't show that income in that month or that year. And it's a month-to-month normally basis is important, but it also is very important on a year 1, year 2 basis. And that can affect your taxes. It can affect a whole lot of things. And again, since we're not accountants, we can't get into that clear definition with you, but the thing we're telling you as a takeaway, make a decision and understand why you're making the decision between being a cash or an accrual business. And that brings us to the terrible trio. Now, I call them that not because they're terrible. They're wonderful. But they're terrible because you have to make sure they're right and you have to make sure they're done. And in most cases, it's the last thing in the world you want to do, that you're equipped to do, that you want to take time to do. And that is preparing your income statement, that's oftentimes called an operating statement, your cash flow statement, and then your balance sheet. And honestly, it took me years to grasp how all these things tie together. So I'm not going to pretend that you can pick this up overnight. And it's why some of you will need an accountant, but you need a professional helping you understand. The fact is that your balance sheet is it really tells you what your business is worth and whether you've made any money or not, whether you're doing what you're wanted to do or what you're supposed to have. In the final analysis, it's your valuation. Your income statement is telling you what's happening relative to your revenue, your expenses, and your profit, and whether you're making a profit. Your cash flow tells you where you are with having the cash that you need. Remember, profit is not cash, but cash and profit are both survival criteria. So you have to understand these interrelationships, and that raises the question, well, if they're a terrible trio, they take a lot of time, and it's something that I'm not going to want to do, and I'm not gifted at doing it, why am I doing it? Who's the first person it should be for? Well, you. You should be the first person that you're preparing your financials for. I know it's tough. It's just one of those facts of life, like having to brush your teeth or take care of certain things. Running your financials, and the better your financials, the more frequently you prepare them, at least monthly. Some businesses can get by with quarterly, but I can't tell you that at least your cash flow, many of you are going to want to do your cash flows weekly, if not daily. Then you've got to have them for your bankers, your leasing companies, your vendors, your investors. It's very important to understand that these three documents become your life. They dictate your opportunities in the future, who will work with you, who will invest with you, and you're understanding them. It's not impressing other people. Remember, it's you getting a good gauge of whether or not you're going to, in the final analysis, make your profit and survive or go forward. Now, let's back up. You've got the documents that have to be prepared. You've got somebody that's going to help you do them. You've got words you've got to know. So let's go back to the starting point. And again, I'm kind of surprised how few. This used to be SIC codes. And many of you may remember SIC codes, but today it's the North American Industrial Classification System. It's one good thing the government has driven. There's many good things the government drives, but this one, from a business point of view, instead of being another regulation or document you got to send in, this is very helpful. You should be very aware of what your business is classified as relative to a NAICS code, National North American Industrial Classification System, because within those industries, and even if you're coming out with a new product or a new invention, there are other players out there who have been in existence doing some form of what you're doing. There's hamburger joints, there's beauty salons, there's manufacturers, there's financial planners, there's consultants. Find the code that most matches your business, and I sent you the link in the email, and we'll be glad to help you find that. And there's several other industry sources we're sending you information out on. And look at what they recommend for a chart of accounts. You can, the great thing about Google, it's easy to find. Once you know your NAICS code, there's a wealth of information. It tells you the standard financial percentages. In your industry, it will tell you companies that make a profit normally make 8% profit, and they normally spend 15% on rent. Now, if you, in your models, are forecasting 20% profit and a 20% rent, that tells you right away there's something wrong. It may not be wrong after you evaluate it, but from the other businesses that are successful in your niche, this is where they're spending money, this is the kind of profit they're making. So you can pull apart, and they'll take it 100%. They'll take your financial statement, that income statement, and that chart of accounts. And a chart of accounts is basically a list of everything that might be on your financials. It's your payroll, it's your postage, it's your cost of goods sold, it's your types of revenue. And then you can also find from that your associations and trade groups, and they will generally, and even if they don't, it'll help you find companies that have pro forma financial statements that you can build for your business plan if you're starting up, and that gives you a whole lot more credibility when you're talking to your investors or your advisors or even your potential team members. And then it will also help you set up your books and working with your accountant or your bookkeeper. And even if you're just doing it on your own software package, it shows you how to set that up initially and helps you develop your models more realistically. So that's a source of starting, and what that should do is give you an initial statement for your income or operating or profit and loss statement. Now, I purposely chose the next three examples. These are Microsoft templates. If you go into Microsoft, and if you don't have Microsoft or you use a more generic product, let me know and I'll send you the templates. But it's a simple income statement. This is what comes out of your chart of accounts. These individual line items are what they're called, and you can go in and change or add them depending on what it is. And then you'll take this out monthly for a year, and a lot of times quarterly, and that'll tell you what you're projecting. Now, again, it's important to have made the decision: am I building these projections as cash or accrual? And I've got to remember that profit is not cash. So if I'm building these numbers, for example, let me just give you a quick one. If I'm saying my gross sales are $500,000, but I'm saying in my industry, people expect 90-day terms. 90-day terms are killers. But some industries, if you sell to Walmart, you're not going to get paid for 90 days. You'll get paid day 91, but you will not get paid day 89. They've spent millions, being some of the best in the industry, manage their cash to the hour. Literally, they will send wire transfers at 12:0001, so they got the interest for before. I mean, that's how sophisticated it is. But then you'll take this revenue. If you sold $500,000, but you gave it on 90-day terms, and let's just say this is January here that you're looking at, and you showed $500,000 in January, that's wrong if you're showing cash financials. That would be out in February or March or possibly April. If you're dealing with somebody other than Walmart, 120 days sometimes drifts into, 90 days drifts into 120. So you've got all these expenses going down here. At the bottom, you'd have these expenses, and it would show, okay, I'm going to be okay on cash. But if you don't get your cash for 3 months and you got to spend this money today, that's where we say, just assume for a moment you made another $500,000 sale the next month, then you've doubled your problem. That's when I say you can sell yourself into bankruptcy. So an accrual, though, you would book the $500,000 here, and it would show a book profit. That's why they talk about a book profit. But you still wouldn't have the expenses. But you may sign in this month if you're in cash, you may sign you may buy a machine for $100,000 that you're going to pay out over 72 months. In accrual, you would only show you'd show that whole $100,000, but in cash you'd only show maybe the $3,500 you put down for a down payment and first payment. So that's why these issues are important. And again, we can't do anything more than touch the high points here, but that's our goal, to have you understand what you got to be thinking about. The same way for the cash flow. Again, cash is how you pay your bills. As I said, profit is not cash. Cash is not profit. And many businesses fail because of poor cash flow. They don't go out and collect the money that's owed to them. They get excited about the sale and they don't look beyond that. I can't. When you hear somebody say cash is king, that's what they're saying. You can survive a lot of difficult times if you've got cash, even if you're not making money. You can even be unprofitable for a while, but you can be profitable and not have cash, and your doors get locked. So the third of the trouble trio is the balance sheet, and as I showed, they feed. The income statement and the balance sheet feed each other. But the point here is that you got terms you're going to have to learn here: assets and liabilities, and then your stockholder equity. That's what you end up being worth. In this particular example of a balance sheet, we show that they actually are worth nothing because their fixed assets are less than what their current assets are less than what their current liabilities are. So they're technically insolvent, and that's why it's important. You normally don't prepare a balance sheet but once a year, and this is where you really generally do need an accountant, and depending on your corporate form for your taxes. But the real test is beyond those trio. It comes down to, in business, the real test is making payroll. If you talk to any experienced free enterprise warrior, in fact, I've talked to some guys. They'll be sitting at the country club. They've run their business for 30 years. One of the things they're most proud of is not how much money they've made, or not that they're at the country club, but I've never missed a payroll. That's a key test of your planning and your execution. And bottom line, I've done both. And true confessions, one of the hardest days of my life. We had right in the middle of the .com bust. We had a $500,000 a month payroll, and I'm sitting at 5 o'clock in the morning with my CFO, and one of our professors is working with us. What we're doing, a check had not come in from that we expected, and one of our investors was slow, and we had to have money in the bank by 9 o'clock in the morning, and we were short. We had to figure out a way to do that, or what to do if we couldn't. So making payroll, that's kind of the battle test for many free entrepreneur warriors. So when you hear people talk about making payroll, that's the context. So like I say, you have these three sheets that manage your business, but that affects these other things that are in this chart here, that even going back to how you relate to your banker. We have a whole class on how you select your banker and working with bankers and who they are and what they are. And I state, with not in any way impugning or putting down bankers. Bankers are some of the worst business people in the world. They generally, particularly at the local level and the non-bank, every person in the bank is a VP, so I'm talking about the people who are running the bank. They don't understand anything but financial statements, and that's all they look at. They don't understand your potential. They don't understand your heart, your goal. They want to see numbers, particularly, and it's, to be fair to bankers, is because they're so regulated today. The last thing they can do is have a regulator come in and classify your loan as non-performing, because that gets taken right off of their profitability and their capital. So your banker is very narrow in what they're looking at. Don't go in pitching a deal to a banker expecting him to share your enthusiasm for the deal. If you don't have collateral, if you don't have a long-term relationship with that banker, if you don't, he's not going to take a risk. He gets no benefit from taking a risk for you, and he gets a lot of penalty if he takes a risk and it turns bad. So understand your banker, but I say this to say you're not going to get a loan from your banker early on in your business if that's what you need, unless it's your personal guarantee against a CD or assets you've already got there. But start your relationship with your banker. Go in there, open an account, buy him lunch, let him buy you lunch, check with him every quarter. Let them know how you're doing, because you'll get at a point where you are bankable. And you don't want to start that process when you need the banking relationship, whether it be doing an acquisition or adding a new line or financing your inventory after a certain point or setting up other leases. You'll need a good banker. It's just part of the process if you're doing any kind of significant growth. But you start that relationship early on and understand who it is you're dealing with. There's a lot of other plates that come into the accounting picture, particularly in the area of compliance and your credit management, your vendors, and again, we're just touching on those. But I want to get into what I call the hidden cost of the finance picture, and that is compliance. That means getting your taxes paid, getting your licenses renewed, getting your insurance taken care of. That's all. Excuse me. It's one thing to list your insurance as a line item. It's another thing to make sure you've got adequate insurance and that it's paid the right way and you've got a competitive rate, and that you're doing what your insurance calls for you to do, so that when you need it, it's in place. For example, that you don't have an unlicensed driver driving one of your vehicles, and just there's all kinds of hidden costs. There's also a hidden advantage here. Rest assured, depending on your niche, that your competitors are not being as careful with these items as you are if you're doing what you're supposed to be doing and balancing all these plates more efficiently than them. That becomes a competitive advantage. Okay, now one of those areas that it's an amazing is the area of taxation. Now, we have a battle book coming out this fall where we're making a major focus on this, but let me just say that the statistics show over and over and over again that 80% of the small business people pay as much as 50% more taxes every year than they legally, morally, and ethically owe. There's just a really messed up attitude in our country about taxes. Because you got to understand, taxes are good. They are important. We have to pay them. They provide our roads. We need a government that efficiently taxes and efficiently uses the taxes. Now, that doesn't mean our system is anything but screwed up because of all the cost of complying. But it doesn't mean you should be paying for their incompetence. And this is a competitive advantage for you. Just like having a lower price on your product, if you can save thousands of dollars a year on taxes, and most of you can, understand morally and ethically, this is at the highest Supreme Court rendering, you should not pay anything more than what you legally owe. Now, there's a lot of difference in tax compliance versus tax evasion, tax versus tax efficiency, and tax avoidance. But this is where I like to say you need a good person on your team handling your taxes. And that's why many of you should be looking more at an accountant than a bookkeeper. If for nothing else, it gives you all the advantages of managing your business better, but gives you nothing more than someone that can manage your taxes properly and make sure that light bulb represents that they're sitting there saying, okay, you owe these taxes, but have you thought of doing this? And let me give you one quick example. This year, and we've helped in the last few years several people, and a couple people we've worked with, and even ourselves, there's a bonus depreciation in hand. And it ends this year, but as of December 31st of this year, if you have taken a piece of equipment, depending on what your industry is, up to $2.5 million, but let's just pick $150,000 of equipment, and you buy it on December the 31st and put it into your business on December 31st. You pick up a vehicle or a new machine, and it's in your plant. You've taken delivery on it by December 31st. You can write that whole $150,000 off, even if you borrowed the money for the $150,000, but you signed it and you bought it and you financed it. Well, for some of you, depending on your revenue situation, that could mean as much as $25,000 to $30,000 in taxes that you don't pay this year and taxes each year afterwards, depending on your depreciation situation and how you handle that. Now, again, I'm not an accountant, but I'm just saying there's a million ways. I'm sorry, that's an exaggeration. There are several hundred ways. If you are operating from your home and you have kids or a spouse, that kid or spouse should be being paid for doing some of the work in your business. Totally different discussion, but everything you pay them is deductible against your profits and one less tax to be paid, plus it's a way to transfer. And again, I'm not that guy, but we spend a lot of time looking at this, and we're going to make a big deal out of this fall, particularly in light of some of the new laws that are being passed. But that's where having the right financial team member comes aboard for you. Now, I actually got through this a little bit longer because I avoided some of the stories that I would normally tell about accounting, because we're going to tell them in more detail. And as I was even working on telling this, the biggest mistake I could make for you, or you could make in listening to me, is thinking that in one hour lesson we've told you what you need to know about accounting. What I hope to do in this lesson is have you understand that if you are averse to numbers, or if you're not using the numbers, metrics to measure your business, and you're not preparing a balance sheet, income statement and cash flow, and you don't know what your balance sheet is, then you are not running your business. It's just axiomatic. Somebody has to be doing it if it's not you. The only caveat to what I just said is if you have somebody doing that for you. But if you're not studying those and evaluating those and you're relying on somebody else, I love the fact we have one person we work with. They finally hired a bookkeeper after getting tired of the husband and wife who'd been working on them. And they were doing very well, had a couple of really good months, and then they finally hired a young bookkeeper, and it worked out well. And 2 months later, they gave her check signing authority on their account because it just made it more efficient. And then 2 days later, she pulls up in a brand new automobile. They're going, so that's not always the case. But if you're not watching the numbers, just south of us here is a little company called, in fact, they're on one of the scenes of American Greed. Their bookkeeper ripped them off for $10 million over 5 years, and it was a family-owned multi-million-dollar business just because no one was paying attention. So understand the numbers, whatever your numbers are, at whatever detail is necessary for you to know what's happening in your business to avoid the surprising of running out of cash, not being able to make payroll, finding out that you've had all these wonderful sales and you've had all this fun, but you're not making any money. That's just something you can't allow to happen. And if you're going to call yourself a business person, you've got to understand that's a part of being on your own and not working for somebody else. Now, next week, I'm excited. While I don't care for accounting other than I respect it, the next part about funding your businesses and finding ways to grow your business, I was sharing with somebody today, many people will say that businesses fail for a lack of money. I reject that, and I'll share with you a couple of sources that also reject that. The simple fact is that the simple fact is that there's more money out there today than there are good deals. There are people every single hour of every single day looking for a place to put their money. Angel investors, institutions, professionals, and for a very, 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 very few of you venture capitalists, they're looking for good deals to put their money in. Your job is to use your numbers and your planning and all the material we've talked about to prepare a story and or then perform to show them this is what I said I was going to do, this is what I'm doing, this is what I can do with a little bit of your money. Then you're going to have a real good chance of getting that money, and you won't not achieve your dream because you ran out of cash. There's no need to run out of cash if you're planning and you're performing and you're building the base that you need to. And that should be very encouraging to you because a lot of you are intimidated about that. So it's not the lack of money, but the lack of the preparation to be deserving of that money that we're going to talk about next week. So have a good week, enjoy the materials, and look forward to the mastermind on this next Thursday. Thanks.